What do we do with the stock of Kimberly Clark, the gigantic household name consumer packaged goods company that makes everything from Huggies and Depends diapers to baby wipes and Kleenex tissues? The stock has been holding up pretty darn well here versus the rest of the market. So this is exactly the kind of company you want to own if you believe we're headed into a slowdown. But then Kimberly Clark reported this morning and its shares price got slammed, went down $4, 3.1%, of what were widely perceived as, by some, not by me, as disappointing numbers. Was the quarter really that bad, though? Company posted a 1-cent earnings miss off of a $1.43 basis, slightly weaker than expected revenues that declined by 6% year over year. Although that decline was entirely attributable to the super freaking strong dollar, as currency caused Kimberly Clark's sales to take an 11% hit. The company's actual organic growth was a stellar 5%. Problem, however, is that this was the quarter where the market has stopped caring about those constant currency figures, only cares about that headline number because the strong dollar seems here to stay. So here's the question. Do we use this weakness as the beginning of a buying opportunity? Stock's now got a solid 2.9% yield. Do we need to get more cautious? Let's check in with Tom Falk, the chairman and CEO of Kimberly Clark. Find out more about the quarter, where his company's headed. Mr. Falk, welcome back to Mad Money.
Hey, Jim. Good to be with you again.
All right, Tom, I got to tell you, I went through this. I went through every piece of research other than a couple of line items in Latin America and maybe something with professional division. I thought it was a blowout quarter. So maybe you can tell me what others are saying, because this is what I want out of a company.
You know, Jim, I feel like this is a pretty solid quarter as well. Our organic top line was 5% with 4% volume. I think for the year, that's the best volume performance we've had since 2007. So we've got great momentum in a lot of the emerging markets, places like China, Russia, Brazil. And we're winning in those local markets. So yeah, the strong dollar was a headwind for us this year, but to overcome that and deliver absolute earnings growth while returning cash to shareholders was a pretty good performance, I think.
All right, I mean, look, we can focus on Brazil. Brazil's obviously a troubled place. I want to focus on China for a second. A lot of people are worried about China. But as you say, the year of the monkey in China is a good year for Kimberly. Can you explain that?
Well, monkeys are viewed as very clever. And so the Chinese will occasionally try to position their births in those good years. Monkey is one. The dragon obviously is the best. But if you're in that mode of picking a birth year and the monkey is close, you're going to wait for that one. And so our team's telling me we could see as much as 7% more live births in China this year, which would be great for our diaper business.
I mean, that would impact, you've got a category opportunity 3 to 4% on average. That would mean that would be a nice acceleration.
Absolutely. Plus, we're going into more cities. You know, we started last year in 105 cities. We finished the year at 115. We'll be in 130 cities by the end of the year. So we've got lots of growth opportunities in China.
Okay, because we're trying to get people to think long-term, which is precisely how you should own Kimberly Clark. I'm also struck that you're focused on the U.S. birth rate, which is at last, after the Great Recession, starting to tick up.
Absolutely. Yeah, we're seeing a slight uptick. You know, consumer confidence is better. The jobless rate has continued to stay low. You know, and so all of that factors into to more confidence about expanding the size of your family. So we're encouraged by that as well.
Now, we all know that energy is coming down back to 29 today. It wasn't clear from the conference call or from your statements exactly when you'll get a nice boost from that, but it's obviously not a headwind for you that energy comes down in price.
No, I mean, you know, we don't use a lot of direct oil. We use a lot of polymer, a lot of polypropylene, polyethylene, some of those derivatives. So we're going to see some lower costs for superabsorbent and, you know, some of the adhesives and other things that are oil-based. Polypropylene is a little tougher because the market in the U.S. is tight on capacity. So even though oil's lower, you know, we're not going to get the full benefit of that. We're seeing pulp prices a little lower year on year. Again, those pulp guys are mostly outside the U.S. and sell in dollars. So, you know, a strong dollar gives them a big boost in their local currency. So, you know, I'd say generally we should see a relatively benign commodity environment in 2016.
All right, now, just because I don't want to be too much of a Pollyanna, I mean, you got a negative. J.P. Morgan does good research on you, and they say organic top line for consumer tissue and professional divisions missed J.P. Morgan's number by 100 basis points and 400 basis points, respectively. Particularly disappointing results in professional. How do you get those numbers turned around?
Well, in professional, we look at it for the whole year, Jim. And so, you know, for the year, we had, you know, a couple of points of organic top line. It was a little weaker in the fourth quarter. Some different causes in the U.S. Distributors took their inventories down a little bit, so our sell-through was still at better levels than that. In markets like Brazil, which is pretty big for us, there you are seeing GDP actually decline and that is having an impact on overall levels of employment and business activity. So kind of a mixed bag, but we've got a strong franchise in KC Professional and expect to see that continue to progress in 2016.
Okay. At the same time, you know, I've been recommending your stock for ages, actually since 1986 when I was at Goldman Sachs.
You're a fan, Jim. We love that.
Look, it's been 30 years that I've been telling people to buy your stock, and it's been one that has really done well. And the reason is you have tremendous cash generation, and you also like to return the money to shareholders. This seemed like an incredible 12.7% year-over-year cash operation, which I know your board decides the dividend, but this has to augur well for your return of capital to shareholders.
Well, Jim, I try to remind our team, it's their money, right? So we run the company for the benefit of our shareholders, and so they should get the benefit from it. So yes, we believe in a strong dividend. We've paid a dividend for more than 80 years and have increased the dividend for more than 40 years, and we'll do that again in 2016. And we've got a strong buyback program as well, as we have excess cash beyond what we need to invest in capital spending. So that return of cash to shareholders is a fundamental about us, and I think the best thing people can say about us is that we're investor friendly, and we certainly try to live up to that.
Well, look, I think you did a great job, Tom, and thank you so much for coming on Mad Money. It means a lot to us. Appreciate it.
Thank you, Jim.
Okay, that's Tom Falk. He's the chairman and CEO of Kimberly Clark. Stock was down 3%. If it gets hit again, what can I tell you? This is a place where you start buying a position. But I'm talking about the long term. Don't be a flipper. Don't be a trader. Be an owner. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.